hear from Lior, last and of course not least, Lior David-Pur. Lior is the head of the Government Debt Management Unit at the Israeli Ministry of Finance, where he's responsible for overseeing all debt management activities. Lior has been actually a great partner for us at the bank. He's speaking in conferences, webinars, and also providing technical assistance as an international expert. Lior is about to finish his PhD in economics and is also a certified global financial risk manager, FRM. So, Lior, I understand that you would prefer to speak from the podium. Feel free, and the floor is all yours.
Thank you very much. So I'm not going to surprise you by saying that I'm going to speak about that my brief talk will be about the inflation-linked bond, but hopefully you will be delighted that it is a brief talk. So I don't know if you know, but a couple of weeks ago I heard that the actor Daniel Craig, known as 007, has retired from his role as James Bond. So basically they are looking for a new Bond. And I have a nice candidate for a new Bond. And I even prepared a slogan, so let's see if you like it. So, okay, thank you. Okay, so I need to improve my jokes, okay, got it. Okay. Thank you. Thank you, I appreciate it. Don't worry, there will be other jokes, so you will be able to participate. Okay, so speaking about index bonds, so the concept of indexation is relatively old. Basically, in the early 17th centuries, Massachusetts, then known as Massachusetts Bay Colony, issued the first linkers, which was linked to the price of the silver. Now, since then, other countries, I think that roughly 20 countries, issued inflation-linked bond. So Israel at the middle of the 50s, UK at the early 80s, the US at the end of the 90s, and other European countries as well. Obviously, other countries have a huge portion of inflation-linked bond, especially in the Latin America, for example, Chile, Brazil, Mexico, but also other countries like South Africa and Turkey, of course, and so on and so forth. So the Israeli story in a nutshell. So Israel had three-digit inflation in the 80s and double-digit inflation in the 90s. So basically, as you can see in the left-hand chart, in 1996, 25% from the debt was foreign currency and 70% was CPI linked. Since then, we were able to decrease dramatically, so the foreign currency portion reduces from 25% to 15%, and the CPI link from 70% to 50%. Now, it's a huge number. 50% is a huge number, but we have to remember that from this portion, we have a unique tool, which is designated bond for the pension fund and insurance company, which basically from the 50%, 30% are those bonds. According to the law in Israel, each pension fund must hold 30% from their assets in designated bond. So this is kind of a unique tool for the government to support the pension fund. So the actual tradable inflation-linked bonds are roughly 20%. We issue on-the-run bonds for 10 and 30 years, and we use switch auction to enhance liquidity by tapping the off-the-run bonds. Both the principal and interest are CPI linked, and there is no floor limit for the inflation, and the index calculated by the Israeli Central Bureau of Statistics. By the way, our rating is AA- in S&P, and the debt to GDP ratio is 60%. So, as promised, the talk will be short, and I will only want to share with you two simple facts. That's it, not big deal. So, fact number one, there is an increasing trend of inflation-linked bond globally. You can see it nice and clear in the lower left chart. The right-hand chart shows breakdown by countries. So, as shown, US in absolute term is the largest issuer by far, following by the UK, Brazil, Germany, Mexico, and also Israel. So, why there is an increased trend? So, advantage number one related to the supply side consideration. Basically, issuing inflation-linked bond assists to diversify the source of funding as shown in the left-hand chart. Second, inflation-linked bond assists to create diversified and efficient debt strategy in terms of cost and risk as shown in the right-hand chart. Advantage number two related more to the demand side consideration. So basically, long-term saving institutions like pension fund and insurance company are natural buyers of inflation-linked bond. As shown in the left-hand chart, 55% from the holding in tradable, Israel tradable bonds are long-term saving institutions. Second, inflation-linked bond assists to some extent, assist investor also in terms of diversification. So, for example, you can see in the right-hand chart that the global linker index, the correlation between the global linker index and the Euro stocks is negative 0.3. So there is also diversification benefit for investors. Other possible advantages, so cyclical benefits. Usually there is a positive correlation between inflation and growth. So when inflation increases, the cost of inflation-linked bond increases. However, the growth increases as well, which increases tax revenue, decreases the refinancing needs, and also improve debt metrics like debt to GDP ratio. So basically, servicing inflation cost may tend to be fiscal stabilizer compared to nominal debt. Second, correlation with government revenues. So future tax revenue should reflect the real activity economy. So rational expectation should assume that the revenue side edge the cost of inflation, which seems as common sense. However, sometimes expectations are irrational and sense is not so common. This one's the second joke. So, okay, you are not allowed. So the problem is also the expenditure side is correlated with the correlation. And usually because the expenditure is higher than the revenue side, so basically net you have exposure rather than natural edge. Third, positive credibility feedback. So this might be true to some extent for countries with high-digit inflation. And also for inflation expectation, so nice to have, you don't have to have it. There is other instruments, for example, real rate swap. So fact number 2, so despite the increase in trend, the share of inflation-linked bonds remain relatively low globally. So in the left-hand chart, we can see that roughly 12% from the 22 trillion US dollars is a linked bond. More interesting is the right-hand chart. Basically, we can see that 14 out of 21 countries share, the share of linkers is below 25%. So the question is, why don't debt managers issue more inflation-linked bonds? Like everything in life, there is also disadvantages, obviously. So disadvantage number 1, linkers are less liquid, as Robert mentioned. So you can see that the daily volume of linkers is roughly third from the total daily volume. Although this leads to the chicken egg question, because volumes are low because low issuances, and issuances are low due to low volumes. So this is kind of a cycle. Second, inflation is volatile and therefore increased volatility in the deficit, in the interest payment, and also in the debt. However, as shown in the lower table, the volatility has been reduced dramatically. So this is less than an issue for the recent years. Other possible disadvantage, so cannibalization between nominal bond and linkers. This is also might be true to some extent because linkers have natural buyers, the pension fund and insurance company. So I'm not sure it's a real drawback. Complexity in pricing, sure. Inflation-linked bonds are more complicated in terms of pricing. Index reliability, prepare yourself. So basically, it depends on the reliability of the Central Bureau of Statistics. So this can be tricky because, you know, as Mark Twain said, there are lies, damned lies, and statistics. So you can never know. I heard the joke. So finally, so one interesting way to compare between linkers and nominal bonds are the break-even inflation, which calculated as the difference between nominal yield and real yield. So basically, when the break-even inflation is higher than the actual inflation, issuing linkers is economic-wise. So in the right-hand chart, you can see In the yellow line, this is the break-even. In the blue line, this is the actual inflation. And in the lower chart, there is this is the difference. So as shown for Israel, most of the time the break-even is higher than the actual inflation, which makes sense to issue linkers. But we have to see that it's not for the whole period. There are periods that it's the opposite. For example, in times of crisis, like 2001, and also in the global financial crisis of 07-08. Also, is it true for all the economies? Also, not really. We can see, for example, in the US, that the break-even inflation is lower than the actual inflation. So, to conclude, and I did it, and I have more 5 minutes. Not bad. Okay. So the share of inflation is remain relatively low globally. However, the trend has been moving towards greater issuances. Like any debt securities, there are advantages and disadvantages. Weighting the pros and cons at the strategic level along with tactical analysis such as inflation break-even and other specific characteristics of each economy are key factors for debt managers to decide whether to issue or not an inflation-linked bond. So, thank you very much.
Thanks a lot, Lior.